Hello, it's Northstar here. I thought I'd record a video, see how it goes, and take a look at the gold market and what's been going on for the last few years and what I think is going to happen in terms of the gold price going forwards over the next few months and the next probably few years as well. So here we are with a gold chart going back to the 1970s, and you can see you can see a number of things on here. You can see the cyclical nature of the gold market. We've got the 8-year gold cycle marked on there. And you can see that the gold price between, I suppose, around about 1980 and around about 2000 or thereabouts was in a general sort of downtrend, and eventually sort of carved out this arc formation with the majority of the touches of the arc on the right hand side there, as price accelerated upwards and moved to the eventual peak around about 2011 there. So since 2011 we've formed another smaller arc that's extended out through around about 9 years or so through to where we are now, where we're just in the process of, or have just recently broken out of that arc formation. You can also, in fact, if I do this now whilst I'm recording, you can see that there has been sort of a bullish flag formation forming, where the flagpole stretches from 2000, 2001, that sort of time period, all the way up to 2011, and then the flag forming in a bullish sort of descending formation over recent years. If we look at a much cleaner, well, actually, before I go away from this chart, as well as the cycles that you can see marked on here, we've got some indicators: the stochastic indicator, the MACD indicator, and the commodity channel index indicator, the CCI indicator. You don't really need to sort of know too much about how these indicators work. What's more important is how price responds when the indicators do certain things. So when the indicator turns upwards, or when you get a bullish crossover on the indicator, how does price behave when the indicators remain in this high sort of zone? Some people refer to this as an overbought zone, but I don't really like that term, because it sort of suggests that you've got to sort of imminently turn back down because you're in a position that's far too extended, and that isn't really the case. As you can see, you can go for many years remaining in the so-called overbought zone, and in fact in a bull market that's what you need. You need the stochastic indicator, this is on the quarterly chart, by the way, the 3-month chart. You need it to remain in this high zone, because that's what defines a bull market. Price is moving ever upwards, and that's supported by indicators remaining in the high zone, certainly in terms of the stochastic indicator. So going forwards for the next few years, I'd expect to see the stochastic indicator remaining in the same sort of high zone above a reading of around about 60. The moving average convergence and divergence indicator moved up steadily during the previous sort of bull run up until 2011. The indicator then had a bearish crossover in 2013 after we'd come off the highs, and then obviously we've seen this sort of sustained sort of bearish trend for several years, till 2016 in fact. So a good few years there where the overall trend was downwards. Between about 2016 and 2019, it was pretty much kind of sideways movement. We had that sort of price reaction upwards in 2016, and then came back down, and it's been going kind of sideways for a while. And then more recently in 2019, around about 18 months ago, we broke out, and I put out tweets and posts sort of stating just how important that breakout was, and how significant it was. And of course, since then we've moved up something like $700 or so, all the way up to the sort of 2000 level, before just seeing a little bit of a pullback. So if we look at the gold price chart without so many lines on, this is what that bull flag looks like, with the start of the sort of flagpole, as we call it, this line here. starting at $250 and winding up somewhere up here around about $1,950 or something like that. So something around about, give or take, sort of $1,700 in terms of the length of that flagpole. To get a price projection, you add that sort of $1,700 to the level of the breakout, which is about $1,300. So that takes you to around about $3,000. Question is, do we get to $3,000, which is our target for this part of the bull move? Do we get to that before the 8-year cycle drop? Well, the 8-year cycle low being in sometime in probably late 2023, I would imagine, mid to late 2023, or even into the early part of 2024. There's probably just about enough time to get up there. If you look at the angle of ascent, if we turn down in 2022, price begins to drop rapidly. We could drop from $3,000 back down to sort of $1,800. So that's a big drop if we indeed go back as far as $1,800, which is this sort of monthly defined breakout level. Don't necessarily have to go quite that far, but it's obviously an area of significant sort of support and resistance. So that would be an area of interest that I'd be looking at, and would represent a very large pullback, at least in line with the 2008 pullback from, what was that, 1,040 down to less than $700. So that was well over sort of a 30% drop. A 30% drop from 3,000 would be down to somewhere around 2,000, wouldn't it? So it's somewhere in that 1,800 to perhaps 2,100 zone is where I'd expect to, just as a first guess anyway, to see the price retreating to in the 8-year cycle low. So that's probably about enough for now. If this video is, if you like it, let me know, and I'll do more of these, and I'll look at individual stocks, and I'll look at silver juniors, and those kind of things, and perhaps uranium and Bitcoin as well. But just as I say, let me know what you think, and whether the technology's worked. I'll have a look now and see if I can post the video for you. Thanks a lot for watching.